YouTube. Okay, if you are on the live streaming on YouTube, that's fantastic. That's great. Be sure to subscribe. Okay, you'll be finding the subscription button underneath. If you actually liking this or enjoying it, give us a like as well. That would be much appreciated. And for those of you joining us today, whether it be Zoom, whether it be on YouTube live streaming, if you have any comments or questions, please be sure to put them into the sort of chat box, comment box, or as I always say, if you've got a thought about what you might actually look to see in future, okay, sort of topics that you might like to see, by all means, please do give us a shout and put your thoughts in there. We're always very keen to take that on board. So as I said, today we're going to talk about Archegos Capital Management. As always, I appreciate that we always have like a real broad sort of spectrum of traders joining us, from those just literally started on their trading journey, and others who have been here a great deal. Okay, so we always try to sort of have something that can basically help provide a little bit of insight and value and help and education to everyone across the spectrum. It'd be fantastic to know what, if any experience or insight you have into the rather stunning episode that we saw happening with Archegos Capital Management about sort of 5-6 weeks ago. If you have any thoughts, or if you had any view, or if you do understand it, or maybe even you don't, okay, just put that in the comment box, in the chat box. That's great, because it helps me sort of understand the kind of the levels that we're talking at here today. But as I said, you're very welcome to be here with us. If you'll bear with us, what we'll do is we'll switch across to the slides, and actually we'll crack on, ladies and gentlemen. So just bear with me a moment. We're just going to share our screen here, and I'm hoping by the magic power of tech that there we go, that we're all up and running. And I'm hoping, as I said, that you can see me, that hopefully you can hear me, and that also that you can see the slides here. So as I said, we're going to talk about what happened at Archegos Capital Management, and probably most importantly for us as traders, what can we actually learn? Okay, because sometimes people, I think, maybe think that these events that are happening at huge funds are so detached, from ourselves that there's nothing that we can learn from it. But you'd actually be very wrong, ladies and gentlemen. It doesn't matter. Doesn't matter whether you're trading a $200 account, $2,000, $200 million account. We are still humans, okay? And there's still always topics that takeaways that we can have from such episodes. Always things that we can learn to help us improve in our own trading. So for those of you who are kind of joining us for a first time for a while, what you might notice is that Admiral Markets is now Admirals, okay? As part of their 20th anniversary, they've gone through a rebranding exercise here. It's not really going to make any difference to you as let's say, as a day-to-day user of Admirals, so just for you to be aware of the kind of the new colours and branding that we find ourselves with here from now on across all of the devices and platforms you'll find Admirals on. And for those of you who don't know, Admirals are a Forex and CFD broker, providing global presence with local support. There you'll find that they are licensed and regulated across a wide range of regulatory environments, providing competitive spreads on the most popular trading products, and allowing the opportunity to engage with markets using both MT4, MT5, and also their Admirals Supreme Edition. If you have any questions about Admirals, get in touch with your account representative, and they'll be very happy to help and guide you. So what are we going to talk about today? Okay, what we're going to talk about, we're going to talk about, well, who were Archegos Capital Management, and in particular, who was Bill Hwang, and also we'll talk about, what actually happened there, and as I said a bit earlier, we're going to talk about, well, what can we learn from this experience? What can we take away, or what can we be reminded of that will help us in our own trading going forward? For those who don't know me, my name's Paul. I've traded for many years across from trading from funds myself to high net worth individuals. My own trading tends to focus on FX indices and commodities. For my kind of swing and position traders, I tend to be a trend trader, looking to sort of ride the sort of surf the biggest waves. And my intraday trading tends to be kind of reversal and mean reversion in style. You'll find insight into some of my trading style on the Admirals YouTube channel, where you'll find lots of fantastic videos and resources from myself and also from my colleagues Marcus and Jens to give you help and education on your own trading journey. So, what happened at Archegos, ladies and gentlemen? Well, what do you know? What do you think happened at Archegos? Do actually people joining us? Do you actually even know? Do you understand? Were you aware of what actually occurred on the during those kind of couple of days in March? Because what we had and what we saw, for those of you let's say who've been completely new to trading and financial markets, is that in kind of the latter half of March 2021. We saw a classic Wall Street collapse as Archegos Capital Management imploded as it attempted to cover its margin calls on most of its positions, which we're about to talk about. In one afternoon, an almost sort of $20 billion of personal capital vanished. That's how gory it became. That's a bad afternoon at the office, that, isn't it, ladies and gentlemen? If you're losing $20 billion plus, that would count as a pretty bad day at the office. I'm pretty sure all of us would be a little bit upset if that happened to us. Not surprisingly, the kind of the big positions and the big moves that we saw, which we'll look at in a moment, that has repercussions, okay? And that had repercussions throughout markets, throughout individual stocks, throughout sectors, and throughout some of the banks that were part of it. And this is what came out as the sort of dust settled on what was a rather damaging few days for specifically for Archegos Capital Management, but also for let's say that kind of the ecosystem that had grown up around their trading styles. And what we're going to do today is this webinar is going to provide just a very simplistic view of what happened, so that you can just basically have an understanding of what occurred, why it occurred, how it occurred, and most importantly, okay, for ourselves as private traders, what can we learn from this particular saga? What is it that we can take on board and then utilize in our own trading going forward? So, let's talk about, who is or rather were Archegos. Okay, it's a name that many people wouldn't have heard of before. Okay, as you'll understand why. And invariably, many people wouldn't, even hear what they be understanding what they are, because they literally kind of almost, in terms of media presence, they show up and they blow up. All right, for want of a better turn of phrase there, ladies and gentlemen. But Archegos Capital Management was the family office of Bill Hwang. Okay, a family office being the key word, which we're going to come back to. Who's Bill Hwang? Well, Bill Hwang was a Korean-born but New York-based trader. And Hwang had, he'd been trading for 20 years. Okay, he had a really very good, long institutional trading career. Hwang had previously built a well-known fund management group called the Tiger Asia Management, and Bill was one of the traders who helped build it, and they were known as Tiger Cubs. And basically, they were known as Tiger Cubs because they came out of being mentored by Julian Robertson, who's a well-known trader, fund manager, and his company, which was Tiger Management. So that's why sometimes you'll hear Bill Hwang termed as one of the Tiger Cubs. Okay, although I'm sure he's got many more sort of nicknames to his credit in the last 6 weeks or so. Okay, based upon whether you were trading with him or through him, or whether he was managing your funds. But as we said, we're going to touch upon that in a moment. But that's where he was. Bill Hwang is he's, as I said, Korean-born but New York-based, deemed to be a very private man, a deeply religious man, a real very simple tastes. Okay, I think he still sort of drove his kind of same Hyundai car. Okay, he wasn't the he was kind of the very opposite of what you might see on TV shows like Billions. He was not Axelrod, okay, with fast jet, private jets and helicopters and big yachts. Okay, he lived a very simple life. Okay, very simple, very humble life. Okay, I think he was the son of a pastor. As I said, he was a very deeply religious man. But as I said, he'd been one of the Tiger Cubs. But what actually happened was Bill helped grow Tiger Asia Management into a successful hedge fund, and they had between about 4 to 5 billion assets under management, which I think he'd started out with I think he was given by Robertson gave him about 25 million to to start his trading career, and he built it up, okay, into about 4 to 5 billion, of assets under management, which is, meteoric rises, okay. But they didn't do very well in the great financial crash, 2008, 2009. Okay, and actually, what happened was by around about 2012, he'd wound down Tiger Asia Management, following a few bad trades through the GFC, and he'd also had a bit of a run-in with regulators. He'd actually been found guilty of insider trading. So he ran down Tiger Asia Management, but actually then started up Archegos with $200 million of his own personal capital in 2013. And if you're interested, or if you want to know why or what happened, well, Archegos is a Greek word for one who leads the way. Okay, so he certainly led the way, and as you're about to find out, ladies and gentlemen, it was quite the roller coaster of a ride, quite the roller coaster of a story. It fascinates. I mean, it is a fascinating tale, and we'll look at exactly where they came from, how they grew, and what actually happened, and what are the what sort of legacies might we see from it. So what actually happened? Where had he gone? Why was he getting himself in trouble? Well, most of you will have known and have seen that over the last year we've seen a rise in stocks. Okay, and certainly in 2021 we've seen stocks rising. We've seen equity indices rise. Meteorically. You see those US indices hitting new highs, constantly hitting new highs on daily and weekly basis. So what we actually looked at is that he used in terms of how he basically in terms of actually how he traded, was what he did is he used cash from his swap contracts to buy even more, and this is one of the things that we'll touch on a little bit in a moment. Okay, that basically accelerated his rise, and we'll talk specifically what is that swap contract, how did it play out. And so at its peak, Archegos had built, around about a $50 to $100 billion portfolio. All right, so I mean that's a big spread between 50 and 100 billion. But invariably, what we'll find out is actually trying to understand, okay, how big that portfolio was, because actually what had happened is he was trading through many banks, from sort of the big banks, okay, as mostly tier one banks like Goldman Sachs, Morgan Stanley, okay, Credit Suisse, UBS, etc. He was trading through lots of them, and so because of those rise and because of the swap contracts, which we'll come on to in a moment, it effectively accelerated the rise. And so at its peak, as I said, they thought they might have somewhere between $50 to $100 billion portfolio. And that actually made Bill himself worth between about 20 to 30 billion himself. And I appreciate that's quite a big range, and that's quite a big range in personal wealth. That's 10 billion between 20 and 30. But as I said, trying to, the kind of auditors are only now just sort of unpicking this, the whole, let's say, debacle, and invariably those numbers will get tighter as we particularly go through and understand, the size of the operation that they were running, and exactly how much counterparty risk there was to some of the major banks that he was trading through. So we just touched on a little bit there, but we'll go into a bit more. Is that his trading plan was to simply to go long on innovation. All right, that's what he was, and in particular, he focused very heavily on what's known as TMT stocks. Okay, so telecoms, media, and technology. Okay, so things like Apple, etc. Or other major telecom stocks. Okay, media companies, which we'll look at both in the US but also in Asia and in China, etc. And that was his main area of focus, TMT stocks. Okay, and as I said, he originally grew, he slowly grew up Archegos Capital to $4 to $5 billion, but actually, as what happened was it actually turned out to be much larger than people had imagined. Why was that? Well, firstly, he operated as a family office. Okay, so he was, in the eyes of the regulators, he was running family money. Okay, he wasn't like an open, it wasn't like effectively an open hedge fund that you could effectively go and put money with. All right. What that meant, okay, and this is what helped him, what that meant is that he wasn't required as a family office to submit what's known as a 13F filing. So if you're a hedge fund, and if you're above the size of $100 million, I might be wrong on that, but it is a sizable sort of kind of fund like that. Well, then what you'll have to do is you have to submit a 13F filing, which effectively discloses the positions that you hold. As a family office, you are under no regulatory requirement to do so. Okay, which means that you don't have to disclose what you're holding. So your position size is very hard for other people to understand your position size, especially if you have positions with lots and lots of different institutions. He also he used swap contracts. Okay, he used swap contracts, and so without operating as a family office, okay, that basically meant he could avoid having to do a 13F filing, and using swap contracts, that basically enabled him to amass very, very large leverage positions. So I appreciate, as always, we've got there are always new traders here trying to understand the mechanics of markets, the mechanics of trading. What do they mean by a swap contract? Well, kind of very simplistic, and I will caveat this as it's a very simplistic understanding, in that really, a swaps contract it's kind of an agreement between two parties to exchange or swap the values or cash flows of one asset for another. Okay. What also helps is that actually well, as we'll explain, is that actually it stays on the bank's balance sheet. So let's have a simple example that your bank, okay, you get effectively your bank to buy you $100 of Apple stock, okay, and then they've bought you $100 of Apple stock, which sits on their balance sheet, not on yours. But what you have to do, okay, is you have to put up $20, okay, as margin. All right. Furthermore, you also have to pay interest on that $80, okay, that $80 of outstanding. So you're effectively owning and running, let's say $100 of Apple, but you've only paid $20 in margin for it, and you're having to just pay those interest rates or interest on the outstanding 80. And what that does, as I say, is that that allows you to amass large leverage positions, and generally he was running positions at around about 5-to-1 leverage, okay, which we will talk more about in detail later. But when you're running those kind of contracts, what happens is that at the end of each day, you settle the account. All right. So if the value of your stock has risen, well, then the bank pays you, okay, the bank pays you the cash value of that rise, which is lovely. Everybody enjoys that. But as always, there's a flip side, okay? If the value of your stocks falls, well, you have to post additional margin that basically helps that the banks feel safe, okay? That helps the banks, keeps them from getting particularly nervous. So if the stocks are rising, you're making cash from it. If the stocks are falling, you're having to post more and more, okay, margin to effectively keep your banks your banks from being a little bit nervous, a little bit worried, okay, about the position, okay. So that's what he used, okay. He operates a family office with avoiding a 13F filing, and he used swap contracts, and by this way he was actually able to sort of grow and amass kind of large leverage positions that basically were very difficult to interpret for let's say other external agencies. And as I said, depending on the data, we're going to work on, he was holding maybe about at least $50 billion worth of leverage positions. And as I said, some people might even say it might even go up to $100 billion. But what's $50 billion between friends? Hey, if you're in a bad position at $50 billion, it's going to be just as bad a position at $100 billion. Okay, so but you can get the impression, ladies and gentlemen, that these were huge leverage positions in these particular TMT stocks. So, with that in mind, what went wrong? Okay, what happened? Well, as we sort of said a couple of slides earlier, at the start, well, in fact, pretty much, from about April of last year, 2020, through this year, what we've seen is in fact stocks were rising. Stocks were rising, faster and faster. And invariably, what Bill was doing, what Bill and Archegos was doing is that, remember what we said earlier about swaps, as they basically rose, at the end of the day, the prices have risen, the bank pays you cash. Well, that cash he was using to effectively to buy more swap contracts, more stock, which was effectively sort of elevating the price even higher. So invariably, prices were wafting higher and higher and higher. And listen, the markets were rising really happily and nicely, and invariably nobody was making too many issues of it. And when it's a rising market and everybody's making money, people sort of just basically gloss over what's occurring. This is, we see this is just human nature again and again and again. But what started to, let's kind of the thread that unpicked it all was that on kind of about end of March 22nd, Viacom CBS, big American company, big TMT, big media company, they announced a $3 billion stock sale, and what came of that was that the share price there stumbled 30% in 2 days, so nearly a third in 2 days. And suddenly, Archegos's leverage bets, their swap contracts, they were doing badly. And remember what we said is, at the end of each day, if those shares are, that stock or your portfolio is, is losing money, well, then you have to post additional margin. So not only is your portfolio going down, but you're actually having to post more and more of your own money, to effectively to keep the banks help the balance their books, and so what was happening is that meant that Hwang had to start selling some of his positions, and so it began, and this was the start of a downward spiral, and we'll look at that and talk about that in a moment. So this is a daily chart here. This is a daily chart of what was, I said, Viacom CBS, and well, hopefully it should be pretty clear what was actually going on here, and when we actually saw what was happening. As I said, this is a daily chart here, and if you remember here, kind of March, April here, this was that was the kind of the COVID crash, should we say, ladies and gentlemen, sort of February, March of last year. But you can see what has been happening there. It was just from where kind of the price was down around about kind of $12 there, ladies and gentlemen. Well, from $12, we battered our way up to $100, and actually, what we saw was, if for those of you who've been on some of the other trading spotlight webinars we've done, that price has been going parabolic there. It's starting to sort of accelerate north, and what I always say to traders is that price can't escape gravity. Once price starts looking like it's going vertical, invariably it won't continue to do that for forever, because it just can't. And what you actually have there is you have a double top, which is a reversal position, and I'm sure you can see for yourself that actually from in March time, from printing a high there, just a smudge, a sliver over $100, well, you can see that actually the price actually was collapsing again, and now we're trading down beneath around about 40, around about $40. So we've gone from $12 to $100 down to $40. So lost $60. Lost $60 there. 60% of its basically its move. And remember what we were saying. Remember what we were saying is that because he was trading these using swap contracts, every day that they were going down, well, that basically meant he had to post more money. So he's getting like kind of a double whammy. So that's the things about managing positions with derivatives. When it's working really, really well, they work really well. When they go against you, they can go against you very, very hard. And and it doesn't, as I said, it doesn't matter if you're a completely new trader or whether you're a previously superstar trader, who's managing billions and billions and billions of dollars. The scales may change, but the actual underlying behaviors, they remain the same, because as humans, we don't change that much. We like to think we do. We like to, because we have such fantastic technology around us here, ladies and gentlemen, we like to think that we are much smarter than we are. And in some respects we are, but in many respects, you scratch the surface, we are still those, primitive cavemen. And when we have events like this, real collapse events like that, it kind of almost like it triggers that kind of primitive caveman behavior in us. So, as we said, that we saw that's the selling started. Okay, as Viacom dropped. Okay, then invariably they had to post more, and the banks started to get nervous. Okay, and what we saw was that as banks started to seize Archegos collateral, and they started to sell large blocks of stock. Okay, and although we as private traders we can see it. If you're at institutions, what you can, it was quite clear coming onto their platforms that large blocks, okay, of stock were being sold. And of course, as that happened, all that did was that actually drove prices down even further, which then basically starts just a absolute selling frenzy. And what happened is we had all the banks joining in, and you might call it like a bit of a classic deleveraging storm. That was what was created, and pretty much I think it was over kind of one Thursday into one Friday. That selling turned into a frenzy, and it was a rout. Okay, it became a rout that basically occurred for both Bill and Archegos. And so, at the start of the week they are riding high. Okay, by the end of the week they're pretty much done and dusted almost. Okay, almost kind of like destroyed. All right, and here in the UK they say a week is a long time in politics. A week can be a long time in financial markets as a trader in hedge funds. Okay, so it's the kind of the message I want to start getting across, as I said, is it doesn't really matter about there might be more zeros on the end, but it's the kind of the scale might be different, but actually in terms of the operating and the kind of the behaviors and the habits, these are the things that we can always learn ourselves. So he had, as I said, he had lots of positions in TMT stocks. So Bido, it's a big Chinese company. I think it's their, if I'm right, it's kind of their one of their like equivalents of eBay. Okay, is big. Huge big company, and hopefully what you can see is already is what was occurring. Okay, from the kind of COVID crash earlier on in the year. Okay, from where it was down around about $80. Well, price rallied its way up to around about $350, and then as we went into March, it was already starting to come off its prices, and you can see for yourself. Okay, from as I said, from being around about $350, well, we're down to around about $170. Okay, so almost halved in price. Okay, and remember, when price was going up here, okay, prices generally going up, well then invariably you're using swap contracts. Well then that was working out for Bill, and all Bill was doing was that money's coming from banks he was using to buy more swap contracts, which was effectively wafting up the share price even more. But of course, as I said earlier, once price starts going vertical, it never stays going vertical for very long. Okay, it just can't escape gravity, and invariably this is what we've seen. And if you look at quite a lot of the charts that are involved with what we discussed, in terms of who he was invested in, they look pretty similar. Discovery, another big media company there. Okay, and you can see for yourself there. For the majority of time, Discovery did nothing. What was that? Bouncing really between about $17 and $25. Okay, and from $25 up to $77. Okay, so it tripled in price. You can see for yourself, but then boom. Okay, as they all started to unwind, my word, didn't that unwind rapidly? Okay, and we've gone from what you can see there around about $77, $78 down to about $36 there. Okay, so once again, it's almost like I said, halving in that particular halving in price. Okay, so this is just it's a fantastic example of when that market can turn, it can turn, and it can turn against very, very rapidly, and it's about as we will come on to. As I said, it doesn't matter whether you're trading a $200 account or a $200 million account or a $50 billion account. Okay, managing risk. Okay, managing risk becomes is always key. Okay, is absolutely always key. And this was another 10 cent. These are this is a kind of like a kind of Chinese media company. It's kind of China music. And as you can see for yourself, okay, it really had been mostly in a block, okay, for a long time, until it kind of at the end of last year started to break out of that, went up. It was in a bit of a sideways move, but made a kind of a bit of a last push up there into March, before we saw price rolling over and dropping dropping down there. Okay, so it's you know, as I said, it was just literally over the matter of a couple of days, everything unraveled and unraveled very, very fast. Okay, you know, really quite clearly. So, you know, it was you know, as I said, it turned into a bit of a rout, ladies and gentlemen. So, you know, when the dust had settled, you know, Archegos Bank had offloaded, they're reckoning what might be up to around about $100 billion of stock. Okay, you know, as I said, the numbers are still being formulated, but it was a lot. Okay, it was huge. It was a big position. What we found is that, you know, the first kind of banks that started selling off Archegos as, you know, collateral, the likes of, you know, Goldman Sachs, etc., had done okay of it. The ones who were later, okay, the later banks, okay, because remember he had positions with lots of them, so banks like Credit Suisse, UBS, Morgan Stanley, and Nomura, and Mizuho, they've lost approximately around about $9 billion between themselves. Okay, so as I said, this is the kind of, you know, the repercussions. It wasn't also just a, you know, a collapsing event for Bill and Archegos. You know, there are repercussions. Okay, the repercussions that reach out from all of them, and the kind of the interesting thing for us, okay, as traders, is that, you know, pretty much all of those, you know, were what you would consider tier one FX interbank dealers. Okay, so of course, you know, if they're having to swallow, you know, if they're having to swallow losses like that, well, then invariably that has a knock-on impact on not only their banks but their other operations. And I might be wrong on this, but I think I might have seen a thing flash through at the start of this week about, I think, how kind of Credit Suisse, okay, are sort of, you know, kind of moving out away from the kind of the trading side of the kind of financial markets, primarily because they just, you know, they've had their fingers burnt, and so, you know, what will happen is they'll move away for it for a few years, and then what will happen is they'll come back to it in a few years, because that's what you find all those banks particularly do. And also, you know, as part of that, Archegos has 20 billion capital base. Okay, you know, Bill's 20 billion to 30 billion capital base, that effectively had vanished into there because it was effectively being used to basically to you know, to fulfill margin calls, those swap contracts, which had done him so proudly at the start of the year. Literally within a few days, completely turned around and absolutely decimated and destroyed. But you know, here are this is the kind of the share prices of the banks. So as I said, Nomura, for example, was one of the ones that got hit pretty hard, took pretty, you know, strong losses, and you can see for yourself there. Okay, you can see for yourself they're up at, you know, what's 720 yen, but you can see, you know, towards the end of March, okay, the share price collapsed there. Again, you know, it's lost probably about a quarter. Okay, but it's you know, that's still, all of these things has impacts, because, you know, invariably other funds will have had positions in the same companies that Archegos had. You know, other companies will have had positions in those banks that have lost. Okay, so there are repercussions here. Okay, it doesn't happen in a silo. Even though it was a, you know, a classic Wall Street collapse, and even though, you know, it was horrendous for Bill and Archegos, there are repercussions. Okay, you know, none of us trade in a silo, and as I said, that doesn't matter whether you're a huge big fund or whether that's you sat at home watching this, trading on your laptop at home. You like to think you trade in a silo, but actually you don't. Okay, the other things that are going on in your life will have an impact upon your trading decisions, in the same way that the other thing that was going on, that, you know, Nomura business, you know, has an impact on their particular decisions and their share price as well. And yeah, you know, and Credit Suisse, okay, Credit Suisse, here we go. So, you know, this was the daily chart here, okay, and once again, you saw how it already kind of crashed there, the COVID crash, and was basically, you know, grinding its way, okay, up until, what do you know, into kind of February, March time, and then as it kind of started to, you know, news come out about, you know, what was going on, well, then you can see that had a huge impact on the price there. Okay, so up from kind of, you know, at $15 down to beneath $9. Okay, so, you know, you've lost about a third. You're right, you've lost about a third there. Okay, in share price over the last 5-6 weeks. All, as I said, all of these repercussions that were coming out because of what had happened with Bill and Archegos. So Most importantly for us as traders, what can we learn from this particular sorry episode? All right. For some of us, who watch it, I don't consider myself an equity specialist, but I was certainly watching this happen in real life because it's fascinating. I'm an operator in markets, and it's fascinating to see this, and it's fascinating to see some of the kind of mistakes that they consistently get made, every few years with institutional trading, all right? And maybe this is the first learning point, ladies and gentlemen, as I said right at the start, It doesn't matter whether you're trading a $200 account or a $200 million account. We are still humans, We're still humans, and we are still, we're infallible, and we're still, we can still fall prey to hope, fear, and greed, regardless of the scale or the size, all right? And sometimes private traders maybe put themselves down and they think that actually they can never hope to compete, with major big funds there. And my question would, my point is always that they are still human beings, they are still capable of making very poor choices based upon fear, greed, and hope. All right, it doesn't really matter in that sense. If anything, it should give you confidence that actually, if you do the important things, and keep doing them well, well, then actually, you can do well. You can do well. This, you should be learning from these kind of sorry tales from other individuals, and learning about how they made the mistakes, the kind of mistakes they made, and how you can avoid them. All right. And you will have heard, certainly from me, and I'm sure from my colleagues Marcus and Jens, is it doesn't really matter what size you trade. You have to respect risk. You have to respect risk. You have to be on top of your risk management, and respect risk, and also understand how leverage can work against you as well as for you. Leverage is a great tool, all right, is a fantastic tool, and it's what allows us to trade in markets. But it's only a great tool if you respect it and you understand risk management and you employ it every single day, because you can see how quickly things can unravel, if you get complacent, or if you get greedy, or invariably, you're just, you're operating in such a way that it's going to come back to haunt you. All right. So this is why, certainly from all of my sessions that we started, Trading Spotlight 18 months ago, is, you'll find myself and Marcus and Jens and Admirals in particular as well, is, we're always stressing risk management first in all of our sessions. If you're not managing risk, you're going to end up as roadkill. Do you want to end up like Bill Hwang? That's the question you have to ask yourself. I would hope not. All right, I would hope not. And the way you can do this, and way you can take it away from today, and work with it, is that what we want is, two very, very simple rules. Two very simple rules when you're trading. Never risk more than a very small portion of your account on a trade, and that might only be 1%, 2%, 3%. Just keeping it very small, and you never ever trade without a stop loss. Now, where you place your stop loss and how you employ your stop loss, that is a session in its own. And if you look on the Admirals YouTube channel, you'll find lots of insight into that, and lots of sessions on that. But if you follow these two rules, you will survive to fight another day, and you'll certainly survive longer than Bill Hwang, and as I said, it doesn't really matter about the size you're trading, ladies and gentlemen. You're having the right, correct behaviors, to invariably ensure that you're always respecting the market, respecting risk, and managing risk to the best of your abilities. You do that every single day and on every single trade. Well, that puts you in a great position. That puts you in a great position. Paul Tudor Jones, one of the my own kind of trading hero, he talks about effectively, you always look to play a good defense first and foremost, and a good defense in trading is about managing risk. That's what we're looking for you, ladies and gentlemen. So in conclusion, ladies and gentlemen, Bill Hwang built Archegos Capital Management from a 200 million personal capital into a fund to one that was worth, his personal worth from it was about 20 billion, and he used that leverage to control what we believe up to approximately 50 to 100 billion, but it was all on the bank's books. It wasn't on his books. He was focusing on TMT stocks, all right, technology, media, and telecoms. And over a few days in March, a deleveraging route occurred, which cost up to $100 billion in positions, and it cost Bill his 20 to 30 billion billion of capital and personal wealth that he created. And as part of that, it's the destruction of Archegos Capital Management. That will be a name that goes into the history books, and it will be undoubtedly 5 years from now. It'll probably be ones that people are being taught on MBAs, etc. about that. But what we can learn from it here today is you can always learn to respect risk and to learn to understand and respect leverage. And you make sure that you never trade without stop loss, and you never risk more than a small portion of your account on any single trade. By doing those two things, you're putting yourself in a good place to start managing risk, okay? That will allow you, okay, even if there are mistakes, even if there are market shifts against you, you will live to fight another day, and you'll learn from it, and you'll get better as a trader. And that's what we want for you. So, ladies and gentlemen, before we go, okay, don't forget to join us next time. So if you join us at 2 o'clock London time on Friday, join my colleague Jens, who's going to talk to understand why serious paper trading is as important as serious live trading. And he's going to talk about, what is trading about, having a little look at our trading brains, and what's the solution to the conflict between System 1 and System 2, which you'll learn about. And he'll talk also about turning a routine into a habit. So when will that be? That's 2 o'clock London time, Friday the 14th of May. Check your inbox for the webinar link, or head over to the Admirals website, to the education element, and sign up to register for the live webinars. I hope you found that useful, ladies and gentlemen. Okay, if it's given you a little bit of insight, as I said, I appreciate we always have like a wide range of people here joining us. Okay, from complete beginners to advanced traders, and hopefully that's just giving you a little bit of insight as to what happened, how Bill and Archegos built this huge hedge fund, and how it all unraveled very, very quickly, and about how what we can learn from it, okay, with our own particular work. If you want to contact us, well, you can do, okay. You can email at global@admiralmarkets.com. You can watch on the youtube.com at Admirals/Admiral Markets, and facebook.com/Admiral Markets Global. And for those of you who use Instagram as well, you can also find us on there, okay, at Instagram at Admirals Global. So please be sure to take a look at that, join us and follow us there, okay, and you'll get updates of all the new exciting things that are going on at Admirals themselves. So there you go, ladies and gentlemen. As I said, I hope you found that useful. I hope you found that interesting. As I said, if you've thanks to those of you who joined us today. If you're watching this on Zoom or on the live streaming on YouTube, as always, what we say is, if you enjoyed this, if you found it useful, helpful to you, please, give us a like. By all means, click on the subscribe button, which means that you'll be updated, okay, to be told when there's more new content, and we're always pushing things out here. And as I said, I hope you found that useful. I hope that found insight. I hope you realize that regardless of the size, there's always something we can learn from it. Okay, we're all still humans. Okay, trying to do the best we can, and managing risk is absolutely key. As always, ladies and gentlemen, I wish you the very best of success in your own trading. I wish you a fantastic trading week, and I look forward to speaking to you on the next Admirals Trading Spotlight Hot Topic webinar. Take care and have a great week. Thanks.